Okay, let's carry on with Unit 13 with another non-conventional loan, which is the VA loan provided by the Administration of Veteran Affairs, or the Veterans Administration. It's a partial guarantee to the lender in the event of default or foreclosure. It's available to veterans, unmarried surviving spouses of veterans, and active military personnel may apply for this VA loan. Specific eligibility is based on the period of active duty or the period of continuous service. VA loans are made by VA approved lenders, and VA can also make direct loans in areas where VA lenders aren't available. This is only for 1 to 4 unit homes, and the VA member must live in one of them, or the veteran must live in one of them. And maximum entitlement varies by the year. They do change it over the years, so we don't actually talk about the actual amount. We do in the book, and we leave that up to the class. But what it does do, it guarantees up to 25%, the top 25% of the loan. Entitlement is the maximum amount the government guarantees the lender in the event the borrower defaults. Certificate of eligibility is required. The veteran needs to get that from their local VA office, who deals in certificates of eligibility for VA loans. And then you can reuse the entitlement once you have maybe bought a home with an entitlement, sold it, and then paid off the mortgage. You can go and get another one, or you can also use any unused portion of your entitlement. You may be required to pay a loan origination fee, and there's no down payment associated with it, but there is a VA funding fee which is waived if you are disabled. You do have to qualify for a ratio, which is the total obligations ratio, just like we've done previously, and that is 41%. Just to go over some of the features, there's no maximum loan limit, and the limit is only based on what they will guarantee. So there's no loan limit. You can get a loan for any amount as long as you qualify, but there is a limit to how much they will guarantee. There is a loan origination fee, VA funding fees waived if disabled, no down payment required on VA loans of the current maximum or less. So the current maximum is somewhere above $400,000 at the moment. If you wanted, say, a $500,000 home, then you would have to put down a 25% down payment on the excess amount. There's no mortgage insurance premium. You can be charged closing costs, and the loans don't have a due on sale clause. Then they could be assumed with qualified people, including non-veterans who are qualified. No prepayment penalty. You can pay off the loan early. And interest rates, like all loans, interest rates are based on market and negotiated between the borrower and the lender on the market rates. And payments include taxes and insurance must be held in escrow. And the maximum loan term is 30 years. To qualify for a loan, this is what we do for all loans. First of all, the lender will want to get your employment history, credit history, and assets and so forth. They'll want to do a credit evaluation and credit scoring on you. They will look at your qualifying ratios depending on the type of loan and qualifying for a property. And the property must appraise out. You can either get a pre-approval or pre-qualification. Pre-qualification is something which you do first of all, just give the lender a call and provide some basic information and figures, and they will do a basic pre-qualification. They won't actually pull your credit report, but based on what you're saying, they will issue you with a pre-qualification letter that you approve for a certain amount of loan. A pre-approval, especially when you've actually found a specific property, then they will go into the full credit application and start working with the underwriter. They will pull your credit and ask for the latest bank statements and pay stubs, etc. And usually this will last for 120 days, the pre-approval letter. Otherwise, you need to get it renewed. Not in the book, but just out of curiosity, when they do pull your FICO credit scores, they do have a different way of doing it than we would. 35% of your score goes towards your payment history, 30% outstanding debt, 15% is length of time credit history, 10% most recent history, and 10% type of credit mix. Now we're talking about where do we get these loans from? Well, we get them from the primary mortgage market. This is where buyers directly deal, made up of primary lenders that originate new mortgage loans. These consist of savings associations who are demand depositors. That means you can put money in and draw it out again as you require. Demand depositors usually have checking accounts and savings accounts. Commercial banks, same, and credit unions. But there is also mortgage lenders who actually, you as a member of the public can't necessarily go along and deposit money and take it out of a mortgage lender. They have investors' money, as also do private lenders used as an investor. An example of a mortgage lender would be Wells Fargo Mortgage, which is actually a separate entity from the Wells Fargo Bank. And using these folks, we call them intermediation or intermediators. We are using them as a middleman. They bring in the money from one place and then they lend it to another and so forth. So it saves us having to go directly to the provider of the services or the goods. So these are thrift institutions. They're financial intermediaries, which are bank savings associations and credit unions. And they allow savings deposits and demand deposits, which is a checking account. And intermediation is by consolidating individual savings accounts of all the depositors and then investing them in loans to other folks. We're talking here about savings associations. They can be chartered by the state or the federal government, but if they are federally chartered, then savings associations have to have the word federal or FA in their name. And they prefer to make conventional mortgage loans, but also make FHA and VA loans and home equity loans. We have commercial banks. They hold demand deposits. That means you can put money in and draw it out with a check. Chartered by the state or the federal government. But if you are a member of the on the Federal Reserve System, then you have to have the word national or NA in the name. They make conventional FHA and VA mortgage loans, and they are insured by the FDIC. And here's an example of a check, a Wells Fargo, and you can just see down here that they have the word NA to show that they are federally chartered. And they make residential and commercial loans. Then we have credit unions. These are non-profit cooperative organizations chartered either by the state or the federal government, and they provide financing for residential and home improvements. Credit unions can make 30-year real estate loans and FHA and VA loans. You have mortgage lenders. For instance, Wells Fargo Mortgage, which is I just told you. A mortgage company, not a bank, makes and services mortgage loans. They sell mortgage loans to non-institutional investors. It is not a depository institution, so you can't go and put in money and take it out. No checking accounts. Primarily makes VA and FHA loans because they are safer. Residential and income properties are included. Then we have a mortgage broker or mortgage brokerage. They conduct loan origination duties. They work with many mortgage lenders, and they don't actually lend money themselves, and they employ loan originators to take in applications. They do not make loans or use their own money. They do and do not service the loans. Works with lenders to arrange loans for borrowers and take origination or a processing fee, which is how they make their money. If you want to work for a mortgage broker or brokerage, you probably have to have a mortgage loan originator's license. And we call them MLOs, and the agents are the middlemen between the borrower and the lender. Might work for a lender or a broker. works with borrowers and lenders to arrange a loan, processes mortgage loan applications. Mortgage loan originators do not make or service loans. If you are doing any mortgage loan application work, then you do have to be work under the Safe Mortgage Licensing Act, which is the Secure and Fair Enforcement of Mortgage Licensing Act. Everybody has to do fingerprints and a background check. There are minimum standards for licensing of mortgage loan originators, but employees of banks, savings associations, credit unions that are regulated by the Federal Banking Agency must register with the National Mortgage Licensing System, the NMLS, but do not need a license. But MLOs who are not employed by federal-related institutions must be licensed by states and registered with the NMLS. It's a 22-hour course to get that. So if you're directly working for a bank and employed by the bank, then you don't need a state license, but you do need to be registered. Many of the mortgage brokers and the lenders, but not the banks necessarily, but sometimes they actually employ the secondary mortgage market to buy the mortgages they've originated. This is an investor market that buys and sells existing securities and mortgages. It helps circulate the mortgage money supply, and it also standardizes loan requirements so everybody knows what they're buying and selling. They're not portfolio lenders. A regular bank may be a portfolio lender. That is, when they take a mortgage on, they keep it on their books until the mortgage is paid off. But very often they won't. They will actually sell it to a secondary investor so they can replace the mortgage documents with a lump sum of money that they can lend out again. Fannie Mae is one of the biggest secondary market mortgage folks, and it stands for the Federal National Mortgage Association. It's a government-sponsored enterprise. It became under federal government conservatorship after the fall. They put in a $116 billion bailout, you and I did. The Federal Housing Finance Agency, the FHA, has supervisory responsibility over Fannie Mae. And Fannie Mae purchases FHA, VA, conventional loans meeting ISCRA criteria. That's another word for conforming loans, as long as they're written to certain standards and values. And in replace, they issue mortgage-backed securities, which are then sold to the investors. So when the banks sell a big pile of mortgages to Fannie Mae, they don't actually get the dollars, but they get mortgage-backed securities, which are like dollar bills, which they promise to pay when they're presented to investors. Freddie Mac is also a secondary mortgage company, and this is the Federal Home Loan Mortgage Corporation, Freddie Mac, and they specifically are the same as Fannie Mae, except they are also government-sponsored enterprise. They are also under federal government conservatorship, and the FHFA does have regulatory oversight. But they typically purchase loans from savings associations. So if you can remember that Fannie Mae does the regular loans and Freddie Mac does loans that have been originated by savings associations, and they primarily concern themselves with conventional loans. The last one we have here is Ginnie Mae, which is actually owned by HUD. It's the Government National Mortgage Association, government-owned corporation, and it is an agency, part of HUD. It guarantees securities backed by pools of mortgages which they take on. It does not buy mortgages or issue mortgage-backed securities, but it acts as a guarantor with government funds to investors of certain mortgage-backed securities. And the question that I've only ever seen on the state and in courses is this one, that they carry the full faith and guarantee of the US government because it is a government organization. There are various types of mortgage fraud which we deal with. Using a straw buyer, for instance, when someone with good credit applies for someone else or steals an identity, this results in mortgage fraud. We also used to have no documentation loans where the lender would take the person's word on the income and spending they had, and they didn't ask for any proof of this. And when you are working with buyers and appraisers, you should have a look out for inflated appraisals or incorrect purchase prices, or indications that there's going to be a last-minute flip to another buyer at closing. If you do get involved in mortgage fraud, it's a third-degree felony in Florida and becomes a second-degree felony when over $100,000. We also have the Consumer Credit Protection Act. This means that everybody is allowed, under certain rules and regulations, to be allowed equal credit opportunity to get a loan. And we're also covering the Truth in Lending Act as well. The Equal Credit Opportunity Act does have some protected classes, and they've included into the normal ones the marital status and age and receipt of public assistance. They cannot discriminate if you're married or what your age is or where you are getting your funds from. The Truth in Lending Act actually informs consumers of exact credit costs. It avoids confusion, applies to consumer credit, including credit cards and car loans and so forth, but also residential mortgage loans. Like any government body, it does not regulate interest rates, and it is implemented by Regulation Z from the Federal Reserve Board. Basically, it is under the Truth in Lending Act. This is going to tell you how much is it going to cost me to get this loan. And we have to disclose to any potential lenders the actual finance charge, the amount financed, the total payments over a lifetime of the loan, and also the annual percentage rate. Also, bait and switch advertising is prohibited. You can't say, come along to see me and get a loan for $1,000 down, and then when you get there you say, no, those aren't available anymore, but I've got one here with $5,000 down, or something like that. And this is an example of what you will see on a mortgage application, or rather the disclosure, rather, what the introductory rate would be and what your APRs are. You see this at the bottom of your credit card statements all the time. Triggering terms. You've got to be careful when you're advertising. If you are saying you can buy this home for $2,000 down and $500 a month, then you have to also include other information. So if you're putting any figures into your advertising, then be very, very careful that you disclose the amount or percentage of a down payment, or the terms of repayment and the annual percentage rate. Be very, very careful when you're doing that sort of thing in advertisements. If you just say lowest mortgage rates available, that is not specific enough to trigger the trigger terms. Here's an example of what happens when you do mention a particular APR or a price per month. Then you have to actually include all the small print at the bottom of the advertisement. When a borrower does get approved and takes out a loan, under certain circumstances they have the right to cancel a loan within 3 business days. This does not apply to loans to purchase or construct a home, but if you take out a loan for a home equity line of credit or a second mortgage or a refinance loan, then you do have 3 business days to rescind the contract. We also have the Real Estate Settlement Procedure Act, RESPA. This is all about how much does it cost to buy this house. Before we had how much did it cost to get this loan, and now we're talking about how much does it cost to buy this house. Under the Consumer Financial Protection Bureau, they have to disclose the amount and type of charges due at closing, attempts to eliminate any kickbacks and referral fees for services offered, and applies to federally related residential loans. Doesn't apply to all cash deals or private loans, and loans secured with a mortgage on a 1 to 4 family home. Then the rules of RESPA kick in. RESPA requirements are: you apply to only 1 to 4 units. The lender has to give the borrower a booklet. You have to disclose any affiliated business relationships you have with any of the other closing services like banks or title companies or attorneys. does require the purchase of title insurance, and it does set limits on how much the lender may take and put into escrow for taxes and insurance. And at the end of the year, you mustn't have more than $50 left, or they have to send it to you. And it also limits or prohibits kickbacks, fee splitting, and unearned fees. And through this, we have a 5-page document, and it's called the Integrated Disclosure Rule, or Integrated Disclosure Document, or Closing Disclosure. 2 disclosure requirements, one shortly after the loan application and one before closing. So when you put in your loan application, you do have to be given a loan estimate required from the lender at a loan application, or within 3 business days, and they have to give you that booklet within 3 business days. And then when you're getting close to closing, and you need to be required with a closing disclosure, the CD we call it, the lender is required to provide to the borrower at least 3 business days before closing the loan. And it's a 5-page form. It's not going to come up for me. Here it is here though. This is an example of the loan estimate, page 1. We'll go through the CD in the class. Finally, we have the Federal Reserve System. This is a government-run organization that controls the amount of money that is actually out on the streets and available to the likes of you and I to go and purchase homes or borrow money. The Federal Reserve Bank is a central banking authority, and it's under the authority of the President, and tools for conducting a monetary policy are used by this system. The first one is open market operations. This is where they will either sell or buy certificates to the public and to banks, offering an interest rate on them, which will either put money onto the streets or take money away from the streets, and thereby reducing or increasing the flow of money out there. When the member of the Federal Reserve System, member banks, want to borrow money from the Federal Reserve System, then they will have to pay their own interest rate. This is called the discount rate. And if the Feds charge a higher rate, then what that will do will charge, the banks will be forced to charge higher rates to their borrowers, and therefore less money will be available because borrowers won't be able to afford the higher interest rates, and vice versa. So if the Feds want to increase the money supply, they will lower the discount rate, and therefore the banks will be able to make more loans. And the reserve requirement, all banks, members of the Federal Reserve System, have to have a certain amount of cash in their vaults. And if we ask them as the Feds to hold more cash in the reserves, then that will mean there's less money available to lend out to the public. So that will reduce the flow of money outside, and vice versa. And there are 12 regional Federal Reserve banks, and they all have boards of governors, and the members of the commercial banks are part of the Federal Reserve System. And that's, I think, all we have. We just got a little diagram here of the various 12: New York, Dallas, Boston, Philadelphia, Cleveland, Atlanta, and San Francisco, Kansas, Chicago, Minneapolis, and St. Louis, and Richmond. So that's where the Federal Reserve banks are. And here's a little more information about it. There has a Federal Reserve Board of Governors, 12 reserve banks, and they have the Federal Open Market Committee. They help conduct the nation's monetary policy. They help maintain the stability of the financial system, supervise and regulating financial institutions, and fostering payment and settlement system safety and efficiency, and promoting consumer protection and community development. And we're just going to go through the 3 separate operations here again, because they will get, they love asking questions on this. Open market operations. Basically, it is the sale and purchase of U.S. securities, treasury bonds, principal method used to influence supply of available money. The purchase of securities increases money supply and reduces interest rates. Sale of securities decreases money supply and increases interest rates. We have the discount rate. interest rate banks pay to borrow from the Fed, short-term interest rate, and this does have a quite a severe effect on the short-term interest rate. Increase in discount rate results in less lending and reduces money supply. A decrease in the discount rate results in more lending and increases the money supply. Then we finally have the reserve requirements. Amount of funds banks must hold in reserve. This is the most drastic method to influence money supply. Most banks have large total deposits in their vaults. A small increase, though, in reserve requirements will cause a large reduction in money supply, and vice versa. A small decrease in reserve requirement will cause a large increase in money supply. You're going to have to remember how to work those out, guys. And there's a quick graphic there which we can see how it actually works, the difference between the open market operations and the discount rate and the required reserve ratio. Okay, that is the end of the chapter unit 13. So thanks very much. A little bit long in the end there, but I appreciate you listening.